Welcome to GN Virtual Classes. We are going to understand key concepts of economics. Microeconomics and macroeconomics are two main branches of economics that focus on different levels of economic activity. Here's a detailed explanation of each. Microeconomics. Microeconomics is a branch of economics that studies the behavior of individual economic agents, such as consumers, firms, and industries. It focuses on the decision-making processes of these agents and how they interact in specific markets. Key concepts in microeconomics. Demand and supply. Demand refers to the quantity of a good or service that consumers are willing and able to purchase at various prices during a given period. Supply refers to the quantity of a good or service that producers are willing and able to sell at various prices during a given period. Market equilibrium occurs when the quantity demanded equals the quantity supplied, leading to a stable market price. Elasticity. Price elasticity of demand measures the responsiveness of the quantity demanded to a change in price. Price elasticity of supply measures the responsiveness of the quantity supplied to a change in price. Elasticity helps determine how changes in prices will affect overall supply and demand. Consumer behavior. Utility refers to the satisfaction or benefit that a consumer derives from consuming a good or service. Marginal utility. The additional satisfaction a consumer gets from consuming one more unit of a good or service. Budget constraint. The limit on the consumption choices of individuals based on their income and the prices of goods and services. Production and costs. Production function describes the relationship between inputs, like labor and capital, and the output that they produce. Costs of production includes fixed costs, costs that do not change with output, and variable costs, costs that change with output. Economies of scale occur when increasing production leads to a lower cost per unit. Market structures. Perfect competition. A market structure with many buyers and sellers, where no single buyer or seller can influence the market price. Monopoly. A market structure where a single seller controls the entire market for a good or service, allowing them to set prices. Oligopoly. A market structure with a few large firms that dominate the market and may collude to set prices. Monopolistic competition. A market structure where many firms sell similar but not identical products, allowing for some degree of market power. Welfare economics. Consumer surplus. The difference between what consumers are willing to pay for a good or service and what they actually pay. Producer surplus. The difference between what producers are willing to accept for a good or service and the price they actually receive. Market efficiency occurs when the total surplus, consumer plus producer surplus, is maximized. Macroeconomics. Macroeconomics is a branch of economics that studies the overall behavior and performance of an economy as a whole. It focuses on aggregate measures such as total output, employment, inflation, and economic growth, and how these are influenced by government policies and external factors. Key concepts in macroeconomics. Gross domestic product, GDP. GDP. The total market value of all final goods and services produced within a country in a given period. Nominal versus real GDP. Nominal GDP is measured at current prices, while real GDP is adjusted for inflation to reflect the true value of goods and services. Unemployment. Unemployment rate. The percentage of the labor force that is unemployed and actively seeking work. Types of unemployment includes frictional, short-term, structural, mismatch between skills and jobs, and cyclical, due to economic downturns. Inflation. Inflation, the general increase in prices across an economy, leading to a decrease in the purchasing power of money. Consumer Price Index (CPI) measures changes in the price level of a basket of consumer goods and services. Hyperinflation, an extremely high and typically accelerating inflation rate, often leading to the collapse of a currency. Monetary policy. Central banks. Institutions like the Federal Reserve in the US that control the money supply and interest rates to influence economic activity. Interest rates. The cost of borrowing money, which can influence investment, consumption, and overall economic growth. Quantitative easing. A monetary policy where a central bank buys government securities or other financial assets to inject money into the economy. Fiscal policy. Government spending. Expenditures by the government on goods and services, infrastructure, and social programs. Taxation. The process by which the government collects revenue from individuals and businesses to fund its activities. Budget deficit surplus. A deficit occurs when government spending exceeds revenue, while a surplus occurs when revenue exceeds spending. Economic growth. Long-term growth, the sustained increase in the productive capacity of an economy, often measured by the growth rate of real GDP. Productivity. The efficiency with which inputs are converted into outputs, often a key driver of economic growth. Business cycles. Expansion, a phase of the business cycle where the economy is growing, characterized by rising GDP, employment, and income. Recession. A phase where the economy contracts, characterized by declining GDP, rising unemployment, and falling income. Depression, a severe and prolonged recession with significant declines in economic activity. International economics. Trade balances. The difference between a country's exports and imports. Exchange rates, the value of one currency in terms of another, which can influence trade and capital flows. Globalization. The increasing integration of economies around the world, driven by trade, investment, and technology. Differences between microeconomics and macroeconomic scope. Microeconomics focuses on individual markets and the behavior of specific economic agents, while macroeconomics looks at the economy as a whole. Objectives. Microeconomics aims to understand how resources are allocated and how markets function at a detailed level, whereas macroeconomics aims to understand broader economic trends and policies that affect the overall economy. Tools and models. While both branches use models to analyze economic behavior, microeconomics often uses models that involve supply and demand, elasticity, and market structures, whereas macroeconomics uses models that involve aggregate demand and supply, the ISLM model, investment savings, liquidity preference money supply, and the Phillips curve, inflation and unemployment. Interconnection. Despite their differences, microeconomics and macroeconomics are interconnected. For example, macroeconomic trends like inflation or unemployment can have significant impacts on individual markets and firms, which are studied in microeconomics. Conversely, the behavior of individual markets can aggregate up to influence macroeconomic outcomes. Understanding both branches is essential for a comprehensive understanding of economics.